Hello, I am Frederick Bell, CEO of Elemental Altus Royalties. We are a royalty company in the sub-billion dollar space, and we differentiate ourselves by having 10 producing assets, the highest revenue in the sub-billion dollar space, credit facilities from the major banks, and a shareholder list that I think is the envy of a lot of smaller companies.
Well, Mr. Bell, good to see you again. We spoke to you not too long ago. We talked about the 2022 numbers, but now you're putting up the Q1 numbers, record first quarter. What can you tell us?
Look, this is partly coming as a result of the merger with Altus that we completed last year. And this quarter is in terms of revenue and adjusted revenue, which is royalty equivalent revenue from across the board. It's up 74% compared to Q1 in 2022. And because our G&A is relatively fixed in terms of adjusted EBITDA, it's up 140% relative to the same period. And that's what you get in a smaller royalty company like ours, where you can grow fast, is you get that margin expansion, where you get revenue growth and your costs are relatively fixed. And that is what we are starting to see this quarter and coming into next quarter.
Look, well, let's just talk about, I want to get the kind of semantics right here. You talk about, record revenue, you talk about record adjusted revenue. Are you just getting cute on the balance sheet, or is this down to the kind of Altus Royalties project?
The main driver for us here is some of the assets from both the Elemental side and the Altus side. And for example, one of them, Bonacro royalty, which is materially starting to come into the royalty area this year. So we're predicting more revenue in H1 this year than we've ever had before. And in H2 next year, sort of ramping up to full production from the royalty area. So it's mostly organic royalty growth from our existing portfolio, with some expected increases in production across the asset base.
Right. Okay. And in terms of, you mentioned the merger, obviously it's happened a while ago, off the back of what was quite eventful last year, for you last year. What's it going to do for you? Because obviously you kind of, I'd say it's been slow accretive growth on the share price. But you're going to need to make some kind of big steps now to kind of get noticed in this in this kind of royalty space that you're operating in. There's lots of people of a certain size, competing for all the same projects. So what do you do about it? What can you do about it now because of that merger with Altus?
I think the key is demonstrating some of the benefits from that merger that we've talked to for a while. And I think in last year, as you said, we had a lot of one-off costs related to the defense and then the merger with the company. And I think now that integration's happened. And so we've got lower cost credit facility and less debt than we've ever had outstanding. And we have more revenue than we've ever had on a quarter basis. And I think Q2 should be another really strong quarter. So for us, we've said that getting some of these assets coming into production and getting them into production simultaneously as a merged entity would enable us to demonstrate a lot of what we have been working for from the beginning of this company, which was to have a real diversified revenue base from, call it, 10 assets plus spread across 7 jurisdictions with 10 different operators, which really de-risk us. And in Q1 and in Q2, I think we'll really see that in some of our results already announced and to be announced in Q2 at the end. We're expecting another really strong quarter, and that will enable us to show, I think, the benefits of having a model that is cash flow heavy from the outset.
Right. Okay. So you talk about having multiple revenue sources from different jurisdictions is helpful. It de-risks. But in terms of de-risking your balance sheet and getting that right mix of debt, available credit, the ability to go into market when you want, might be able to move quickly. How do you construct that? I mean, clearly the revenue is important, but what else is important?
So I think with the building up on the revenue side, we've started, and we've spoken to this in the past, is we've started to add assets in the pipeline, development pipeline, and we did that in Q1. We did that in Q1 more so than we've ever done to date. And one of those assets that we bought a royalty on, Pickle Crow, they increased the resource from roughly 2.2 to 2.8 million ounces following that acquisition. And they've taken that resource from, I think, 800,000 ounces a few years ago to 2.8 million ounces today. So if we can add in using our existing revenue. If we can add in some really good quality assets into the development pipeline, it puts us in a really strong position to continue growing, but to continue growing without as much dilution as we would have to take if we had no revenue and we had to raise money from the market every time we did anything. And it also insulates us to the extent that in a bad market, we can choose when we raise money, and we can choose when we go to the market and if it makes sense or not. And really, we're going to be raising money if we are to do new acquisitions. And so we have the ability to make that call. Whereas if you don't have positive cash flow, if you don't have revenue, you are, I think, like a lot of the mining space, you are very dependent on sentiment. And as we know, that can be difficult in the bad times when you're forced to raise money.
Well, I think we're in some of those bad times right now for a lot of companies. Right now, they're looking for alternative finance. And we talked about that last time you were on. This alternative financing to them is when they're finding it very expensive to raise equity, or if they're, also looking at sort of debt, and debt is not necessarily a cheap option for them, kind of pre-production. So, are you continuing to have more of those same sorts of conversations? Are you continuing to see more deals on the table at the moment?
Yes, that's definitely the case, and I think it's probably something in common with feedback you might get from a lot of our peers, that there are a lot of interesting opportunities on the table at the moment. And part of what we wanted to demonstrate, and we now do it on a quarterly basis in our presentation, is we have a slide on some of our historical investments and what we paid for it and the revenue received to date, and what the valuation is. And we've got, from those producing assets, just focusing on the producing ones, we've got, I think, 2 assets that have fully repaid us already and more. We've got 2 assets that have probably repaid us 75% since we acquired them. And as every quarter goes by, the benefit of producing assets is we can show that return that we have demonstrated, so that then when an opportunity comes up that we think is a really good opportunity, we can take that track record of good acquisitions and we can go to the market if we need to raise more money, or we can use our existing cash and do it. But that again comes back to, I think, the approach of the hardest part in this royalty business is getting good quality producing assets, the holy grail of the royalty space. And if you can do that, and you can do it in a way that over time you can demonstrate has been accretive, and you can do it in a way that de-risks the company. And today, I would say we've got less downside risks than most $2 billion mining companies, in terms of diversification, and in terms of our cost base and our exposure, which is to top line revenue. So for us to be able to do that as a $200 million market cap company, roughly, to be able to do that in our position really gives us a platform to grow from.
Okay, I hear you say you want that kind of creative growth, and obviously overpaying for an asset with expensive money that you borrow, whether it be credit or having raised equity, that's not the way to do it. If you look at today's marketplace, you say it is kind of tough for some companies out there looking for, trying to manage their own cost of money issues. How do you go about assessing whether or not you go now? Is there always a right time, or was there a wrong time to actually go and make these acquisitions? Because it seems to me in moments like this is where you guys should be absolutely going for it.
Yeah, it's certainly busy on the BD front. And I think it's always it does partly come down to availability, free cash flow, and investments. And if you have to raise money, what the cost of raising that capital is. So there is an interplay there. And one of the benefits as you get more scale and you get more revenue is you have increasing margins, which is exactly what we had in Q1, record margins in terms of actual free cash flow coming into the company. And as we increase that, we have more money to deploy into the market. And so I think the best time to be a royalty company, and the best position to be, is to be in a weak equity market where you have cash available to deploy. And that's always been our focus. If there's a good market and everything's very positive, commodity prices should rise, revenue will increase, and we'll do relatively well. But what we really want to do is position ourselves for when times are tough and there's limited capital available, and we can actually deploy capital into really good opportunities when there are limited options on the table.
Do you think you've been able to demonstrate that you have allocated capital wisely? On average, obviously, I think, mining stuff, it's hard to call these things, but do you think you've got it right enough times for you to go and be able to have conversations with groups who may give you the money to be able to make these acquisitions, or do you still need a little bit more, time to kind of prove yourselves out?
I think that's absolutely the case, and I think that's the case. That rationale and that sort of the proof is in our shareholder base, and I don't think we would have a shareholder base that is, I would say, more institutional than any of our peers, without being able to demonstrate those real tangible returns. And if you go back and look at our first royalties to date, Quale we paid under $1 million for. We've received $2.3 million to date. Mount Pleasant we acquired for, I think, $500,000 up front, and we've received about $400,000 to date. And this is not including what the present day value of these royalties are, which, for example, in Mount Pleasant's case, call it $1.5 million order of magnitude. And then, you can go through the list. Mercedes with 50% repaid on, and it's probably worth 5 times what we paid for it originally. And this is exactly why we put this slide in our presentation. And it's why every quarter we can update it as we receive more revenue from some of these assets, to be able to really front and center show investors, look, as time goes by, these acquisitions, we hope, should look better and better. And we should be able to, it's one of the benefits, particularly with producing assets, is we should be able to demonstrate that. And there's already been, I think, 2 resource updates across the portfolio in some of our companies this year. We have been guided, and a few of the operators are guided to further updates over the course of this year. And what does that really mean for us? It means that someone else has spent a lot of money exploring and adding value to royalties that we have at no cost to us. And each of those makes our previous acquisitions look better. And so I think it's why in the royalty space, you look at a lot of the companies that have been around for 10, 20 years, and some of those royalty acquisitions look fantastic. But I'm sure there may have been some people on day one when they bought it who said, well, at $400 gold and with 500,000 ounce reserve, it looks fairly priced. But fast forward 20 years at $1,800 gold, and maybe the resource is the same as it was then, it suddenly looks like a fantastic deal. And we have ones that have been ostensibly great value deals from the outset. I think that's where we really built our name, enabled us to raise money and build the company from scratch to here. But also in some of the bigger projects we got, where we really saw exploration upside in them. And I think some of the results that will come out over the course of this year, going into next year, will demonstrate that. So
your revenues and your margins may be inflation proof, may be market insensitive in that sense. But in what other ways are royalty companies, immune to market conditions, if at all? So
I think I'll probably say 3 aspects. I'd say the inflation proof is probably a really key one. And this has been a topic in the industry, which is inflation in salaries, inflation in costs, inflation in raw materials, and how that feeds through to the industry. So the gold price goes up by $200, say from 1,800 to 2,000, as an example, goes up roughly 12%, or 11%. And what is the inflation in their costs underlying? And that may take some time, but that's where a royalty company has an advantage, because we don't have that underlying material cost base. Number 2, I think advantage for royalty companies is when you can get revenue generating royalties, and you can build a real sort of defensive position. What I mean by that is that if commodity prices come off by 20%, that can be the entire margin for a lot of operators. For a royalty company, the whole reason we've worked so hard to get in this position is so that if commodity prices come off 20%, we will have, roughly speaking, 20% less revenue, but we will still be cash flow positive, and we will still have money to deploy into the market, and it will probably be a market that is far more conducive to writing new royalties. So that is how we've approached it. And then I think number 3, third aspect is the leverage and optionality we get. And there's a whole range of ways we can talk to that, but optionality to exploration, optionality to commodity prices, optionality to technology. And if I'm an operating company, it may take me 3 years and $100 million to discover those new ounces. And at what cost is uncertain. And we have to allocate capital every year to it. If you're a royalty company, we have 3 years to wait, but we don't have to spend another dollar. And if you are a gold bull, and in our case, we have material copper as well. If you're a gold bull or a copper bull, we are about getting exposure to long life assets. And our 3 core assets, we think will be generational, multi-decade long assets that give you uncapped optionality to gold and copper prices. And if we can do that in a vehicle that is de-risked, that has revenue to cover its own costs for the next decade out, that is going to have more money to redeploy into the royalty space and be able to show that you've redeployed that money accretively and successfully, then I think all of those combined to put us as a really attractive investment proposition.
And then finally, I know you've been busy, putting together things with regards to Altus and yourselves in terms of all the paperwork required for that merger. But when would we expect to see the Q2 numbers come out? Will they be a little bit quicker than the Q1 numbers?
Yes, definitely. So, look, Q2, typically we receive our royalties a month post period end. So for Q2 ending in the end of June, we'd get our numbers internally at the end of July. And so probably 6 weeks after the end of the quarter is generally what we say. So mid-August, 6 weeks after the end, we'll probably have our results out. Sometimes we're able to put out a trading update, sort of unaudited, but guiding to revenue numbers in advance of that. And we may, sort of depending on visibility we can get from our counterparties. In some cases, we may be able to do that. But certainly, yes, expect our Q2s out in the mid-August period.